different speeds that this is going to happen at. And the market has already taken the lead on the speed of drawing down. The economy, this is going to be a slow grind lower. And as we've mentioned already, the labor market is one of the last things to turn. However, Jim, I want to respectfully disagree with you on one of your points. There are cracks in the labor market. We've got challenger job cuts going up. We've got a slow increase in initial jobless claims, a slow increase in continuing claims. There's layoff announcements. I think that just continues to heat up. First, we need some of this earnings stuff to catch up. I see price targets coming down, then earnings revisions come down, then the economy follows. And a lot of it is moving lower. It's just moving lower at a slower pace. So if and when the Fed is satisfied that inflation has come down for enough months, I'm going to call that 3 consecutive months of month-over-month declines, then they might say, okay, no more 50 basis points. Now we do 25. Yes, the market rallies on that. That still may not be enough to take care of inflation, in which case you have the risk in 2023 of a real pullback, a real recession that takes care of inflation.
Very well said. Jim makes the argument, though, Jim, that there's nothing to see here, that the economy's booming, because you go out to restaurants and you go to the airports and everything's packed, and then you look at, we're all of a sudden onshoring all of the supply chains. We got no issues there. We're building factories everywhere. You've got the infrastructure spend. Drunken sailors are throwing $100 bills out of that. There's like nothing to see here, is your argument.
No. I mean, of course, there is something to see here. And the thing that we all see is where the stock market is, with the S&P 500 down whatever it is, 19% from the year-to-date high. So that is obviously something to see. The question is, what do we do from here? And what I'm submitting to you, I understand. I read what Mike Wilson says. I read what Brian Rauscher at Fundstrat says. I understand the bear's argument. The point that I'm making is two things. One, it's ignoring the damage that's been done, and two, it's ignoring the positives. And, listen, you mentioned quantitative tightening a second ago. Okay, obviously that's a negative. On the other side of the ledger is the improving tax receipts at the federal government level, which is shrinking the supply of treasuries. So a buyer is going down, namely the Fed, just as supply is going down. They're offsetting phenomenons.
I understand that, but one case seems like it's being made with facts, and a large part of your case is being made with fantasy.
I don't think so, Scott. Now listen, I know you and I like to spar, and I like it too, okay? But I don't think it's fantasy. I don't think, number one, the jobs report, I don't think it's fantasy. I don't think the job opening and labor turnover survey versus the unemployed is fantasy. I don't think the semiconductor plants that have been announced. I don't think the lithium mines, the rare earth element processing facilities, the automobile plants, the battery plants. I mean, they're factual.
Jim, when are these opening? Are these opening on Saturday? Is there like a ribbon cut? Are they like? Are we running through the doors on Saturday morning? What time do I need to be there, Jim? Because the way you speak of it is that all of this is coming online next week.
Scott, it's going on right now. Taiwan Semi's been building its semiconductor plant. It was the first one to announce it. That was about a year and a half ago. And that was followed quickly thereafter by Samsung and Intel. These things are going on.
So last point, quick, Jim.
Scott,
Joe, and then I got to go. Hold on, Weiss. I'll let you go after the break.
There's a lot of things on a daily basis you can change in your life. The one thing you can't change is time. I've been talking about this forever. I think it's why it's so frustrating, is because this is the classic U recovery, and we haven't seen this in decades. This is a U. You have to wait for clarity. You're not going to get a V-shaped recovery anytime soon. And the probability is that the S&P is just going to vacillate on either side of 4,000, maybe dip to 3,500 for an extended period of time. That's frustrating, but that's what this is.
All right.